The year 2025 began with palpable tension in global markets, but without the dramatic collapse some had feared. In the United States, the average consumer felt the weight of political decisions every morning, in the price of coffee, which had risen 12% since new tariffs on Chinese imports, in the cost of electric car insurance, now 15% more expensive, and in the uncertainty about the future of employment at the local factory. Meanwhile, in Shanghai, BYD executives celebrated a record 1.2 million EVs exported to Europe in the first quarter, even under 25% European tariffs. The reality of 2025 was a fragmented world, where each economic move generated contradictory effects, and Americans were learning to navigate this new geopolitical board. The U.S. economy was walking a tightrope. Annual inflation had fallen to 2.8%, but still kept the Federal Reserve cautious, with interest rates between 4.25% and 4.5%. On Walmart shelves, electronics prices told a silent story. Flat-screen TVs dependent on chips made in China rose 8% after Trump's tariffs. Made in USA products, like Stanley Black & Decker tools manufactured in Texas, were gaining space, although they cost 20% more than their Chinese counterparts. In the automotive sector, the EV revolution was progressing unevenly. Tesla, once the undisputed queen, saw its global share fall to 12%, while China's BYD reached 19%. In California, Tesla's Fremont Gigafactory was operating at 70% capacity, challenged by the scarcity of graphite for batteries, a mineral controlled by China. Meanwhile, Ford was accelerating its partnership with SK Innovation to build batteries in Tennessee, taking advantage of subsidies from the Inflation Reduction Act. China was facing its own demons. Economic growth had slowed to 3.8%, and the real estate sector was still bleeding from the Evergrande crisis. But in strategic sectors, the dragon was advancing. It controlled 76% of the global EV market and 60% of lithium battery production. When the European Union threatened to tariff Chinese EVs, BYD responded by opening a $1 billion factory in Hungary, a move that saved European jobs while flooding the market with vehicles priced 30% lower than local competitors. Global investors were dancing a calculated risk waltz. The S&P 500 had fallen 10% since February, spooked by trade tariffs, while China's CSI 300 index had risen 5%, its best start to the year in 23 years. Large managers like BlackRock were rebalancing portfolios, reducing exposure to the Nasdaq, affected by AI regulations, and increasing stakes in Chinese semiconductor companies like SMIC. In the geopolitical backstage, the technology war was escalating. When the U.S. banned the export of NVIDIA GPUs to China in 2024, Huawei responded with the Ascend 910B chip, 80% as powerful as the best Western ones, but sufficient to train AI models. Meanwhile, in Phoenix, Arizona, TSMC was inaugurating its third 3nm chip factory, subsidized by the CHIPS Act. Global trade had become a multidimensional chess game. Trump's tariffs, 20% on $300 billion in Chinese imports, raised U.S. consumer prices by 0.7% in 2025 alone, according to the Peterson Institute. In retaliation, China restricted exports of tellurium and tungsten, critical minerals for the defense industry. The result? Lockheed Martin reported 18% increases in Javelin missile production costs, while Iowa farmers suffered from 45% Chinese tariffs on soybeans, ironically benefiting Brazilian producers, who saw their grains soar 22% in the global market. The Federal Reserve was walking on thin ice. Jerome Powell was signaling interest rate cuts for 2025, but trade tariffs complicated the equation. Each 1% tariff adds 0.1% to inflation, warned Treasury Secretary Lael Brainerd. Uncertainty kept companies in cautious mode. Equipment investments fell 3.1% in the first half, while the stock market saw record volatility. The VIX oscillated between 22 and 29 points, reflecting traders' nervousness over each Presidential tweet about China. In the traditional automotive industry, adaptation was painful. General Motors closed 3 combustion engine factories in 2025, while inaugurating a mega battery factory in a joint venture with LG in Michigan. The energy transition was showing its fissures. Gas stations in rural areas were closing, while supply chains for electric chargers struggled to keep up with demand in metropolises. Meanwhile, China was aggressively diversifying. The $400 billion deal with Iran in oil for digital yuan threatened the dollar, while the Power of Siberia 2 pipeline, bringing Russian gas to Shanghai, reduced the West's energy dependence. But not everything was rosy. The real estate bubble had left 65 million empty apartments, and youth unemployment hit 21.3%. For the U.S., reclaiming industrial sovereignty brought lights and shadows. The CHIPS Act had generated 120,000 jobs in semiconductors, but a shortage of qualified engineers kept positions open. In North Carolina, Wolfspeed was building the world's largest silicon carbide chip factory, dependent on Dutch ASML machines, which, in turn, used Taiwanese components. Global interdependence proved indestructible, even amid decoupling discourses. On the political front, rhetoric was intensifying. Donald Trump Jr. tweeted, "Biden handed our future to China," while the Chinese ambassador in Washington warned of severe consequences to tariffs. Behind the cameras, however, diplomats were working to avoid the worst. Provisional agreements ensured the flow of Chilean lithium to American factories, while Chinese companies bought rare earths from Texas via Mexican intermediaries. Globalization hadn't died. It had just become more complex. For millions of retirees, 2025 was a year of portfolio adjustments. Pension funds like CalPERS increased allocations in gold, 8%, and Brazilian agricultural land, 5%, while reducing treasury bonds. Small investors were migrating to thematic ETFs, clean energy, cybersecurity, and even medical cannabis, sectors less exposed to the trade war. American innovation still shone in niches. Moderna launched a universal flu vaccine using generative AI, while SpaceX reached a crucial milestone, fully reusable rockets reducing launch costs by 60%. Defensively, Northrop Grumman was developing underwater drones to monitor internet cables. In the Pacific, a response to suspicions of Chinese sabotage. In retail, chains were adapting. Home Depot was stocking more DeWalt power tools, made in North Carolina, and fewer from Chinese TTI. Best Buy was creating China-free tech sections with Dell and HP products, but faced protests over 30% higher prices. As 2025 progressed, a new balance began to emerge. Global chains, although more expensive, were becoming resilient. Intel was producing chips in Arizona using Ukrainian neon and Irish argon. German automakers like Volkswagen were investing $700 million in factories in Tennessee, protecting themselves from both American tariffs and Chinese dependence. For the average worker, the transition brought hybrid opportunities. In Columbus, Ohio, former steelworker Luisa Martinez was now training AI systems at a logistics startup. Her salary had risen 25%, but the requalification journey had been exhausting. It was 2 years of night courses in data science. It wasn't fair, but it was necessary. Stories like hers dotted the country, a testament to the adaptive resilience of the American economy. On the horizon, 2026 promised new challenges. The extension of exemptions for Chinese graphite would expire, testing the U.S.'s real capacity to create domestic battery chains. The American presidential election was heating up the debate on trade versus protectionism. Meanwhile, China was preparing its 5-year plan focused on technological self-sufficiency, a chess game that promised decades of fierce competition. In some 2025 was not the year of American collapse or Chinese hegemony, but the beginning of a new era of economic multipolarity. For the U.S., the lesson was clear. Innovation and adaptation, not panic, would determine its place in this emerging order. And for the common citizen, navigating the complexities of this new world remained the ongoing challenge.